have you on the show. Basically, you're one of the few fractional CFO type of people in Southeast Asia for startups. And we need more people like you so that, everybody can get on the same page around financials. So I'm excited to share and talk a little bit more and talk shop with you.
No, thank you, Jeremy, so much for having me in the show. It's a real privilege, and yeah, really excited to share sort of more about what we are doing at Finprojections. And we are definitely trying to add some value in some small way to the startup ecosystem, and really excited to share what we have coming 2 months.
Awesome. So Sadaf, please tell us who you are.
Yeah. So Jeremy, so I'm working in Singapore as an investor. I've been working here for the last 3 years. But my sort of identity, I'm originally a Bangladeshi. I've been born and brought up in Bangladesh. I grew up, in Dhaka, which is a massive sort of a massive city. Very crowded, very buzzing. And from there, I decided to pursue my undergrad education in a completely different setting in Minnesota, in the United States. So I traded essentially, a capital with basically a small town in Minnesota. Went to college in Carleton, which is a small liberal arts school. Uh, Studied math and economics at Carleton. And then after graduating from Carleton, I was really fascinated by the capital markets in the US. And so I decided to banking for a few years. So my original identity, professional identity, is that of a banker. But then I transitioned over the course of my career to becoming an investor, particularly an emerging market investor. And happy to tell you more about that. And that's kind of the line that I'm currently in. One of an emerging market impact investor, but also the venture Finprojections that you mentioned is also something that I'm doing on the side and trying to build up for the local startup ecosystem.
Amazing. And you is when did you fall in love with financial modeling and Excel?
Yeah, so actually, it was in my first job. I mean, it was almost so my first job was out of college, was working with an investment bank. And in investment bank, I think they put you through basically the works of intensive training in Excel and technical sort of training on financial modeling. So you almost have to learn financial modeling by necessity. But I think what really sort of built this love for financial modeling for me personally was how you could tell stories with financial models, and how you could paint a picture of a powerful narrative with a financial model. And in my first job, which was with Goldman Sachs in New York, where I was doing a lot of corporate finance transactions, essentially the story was one of rebuilding and rejuvenation. Right? Here are these companies that are often highly leveraged, and they're trying to restructure their credit to become a better organization. And how do you convey to investors how that is going to happen? What are the value levers that you need to pull or you need to shift in order to make that transition happen? And taking that very complex story and distilling that into a financial model and then presenting that to investors. And then later in my investing career, I also saw the same, but from a buy side perspective. How would an entrepreneur or a founder convey the same to an investor with a financial model that tells a story of the potential and the prospect of that business? And that's what really excites me about a financial model, is that it can tell a story beyond the numbers.
Yeah, amazing. And is really important off the bat, which is telling a story with Excel and numbers, right? Which everyone's like, what? That's impossible. Like, don't you tell a story with words, with your face, with the speech? Don't we spend so much time teaching and coaching founders about how to present and craft a narrative? So what does it mean to have a narrative with numbers?
Definitely. I think, I'll talk about the startup ecosystem. I think that's the most topical also to your space, Jeremy, as well. And maybe a lot of the audience would relate to that also. From a startup perspective, I think telling a story means, telling a story that is focused. And that requires not just putting that story into the Excel model, but even before you do so, taking a step back and reflecting. Um, what is the overarching strategy of this business? What is the long-term strategy? What do you aspire to be? And often the risk, I think, that entrepreneurs typically take in this process is that they want to do too much, and that is very emblematic of a typical founder, who is very excited, who wants to drive and make change in all kinds of different directions. But when you're talking to investors and we're trying to communicate, I think it really helps to have a very well crafted and specific vision of the future, which can also be supported with a financial model. And so you're taking sort of that overarching story, which is focused, which is very easy to understand, and then you are distilling it down into numbers, so that now there is a practical element to understanding this story as well, in terms of numbers and projections and what kind of traction you want to achieve. So, I think really, in terms of telling the story, the most important part is not even doing the financial modeling, but taking a step back and thinking about the overarching strategy first, and making it as narrow and easy to understand as possible.
Very true. And I think one reflection is that, when people start out with their first fundraise from friends and family, angel, obviously, that the idea can be as simple as, okay, we want to make X easy, right? Or we want to be the Uber for Y. I think there's an easy narrative component with a vision, and I'm not saying that everybody, has the perfect pitch. I mean, it's like a bell curve of performance at that first deck.
Right.
And of course, people are improving over time. Some people lag behind over time. Some people accelerate in terms of how they storytell. But what's interesting is that as the company proceeds and starts to build out traction, have results, what happens is that I think founders kind of lose track, and they think it's about the story, because they still think it's, the friends and family round. Entering the Series A, the Series B, that's where numbers are now starting to show and the numbers are not, like I always tell people, it's not like fake numbers or numbers that dance, right? It's really like there's a certain reality about your business that's happening today, right? Which is that you've executed with the cash, whatever you have, for the past 1 to 2 years. And so these numbers are just measurements of that activity over time. And being able, of course, level one is being able to state those numbers well in a clear way, so that nobody's digging around for that. But also level two, which is what you're talking about, which is how do you project the future? I think level three is projecting the future in a way where we understand what the risks are and what the key things we need to de-risk as a milestone, right? Because at the end of the day, if this was a sure bet, there wouldn't be VC requirement. Everybody would throw money at you if it's a super no-brainer. So what we're trying to kind of say at the Western model is to say, if we get everything right, this is what the future looks like. And if we get some things right, this is what the future looks like, right? And this is how we're going to achieve those things. What do you think about that? Yeah.
No, absolutely. I think definitely, and that's why, I mean, Jeremy, I think that's very sort of perfectly articulated. And that is why I believe that even from the founder's perspective, financial modeling can be such a powerful exercise, right? Because it really builds an appreciation for what are the underlying drivers of the business. I think number one, and understanding that to a deeper level, and number two, as you said, sensitizing and creating scenarios, right, of what does the upside, base case, and downside look like. And also, preparing yourselves in some ways as a founder for the downside scenario. If for example, the capital became very difficult tomorrow and you couldn't raise the next round, how would you respond to that? Or for some reason there was some sort of market dislocation, how would you respond to that and pivot? I think some of those things you are a little bit more prepared for if you have gone through that exercise of running those scenarios and even developing that plan in advance of how you're going to respond to those stress scenarios. So yeah, beyond being a tool which is required for diligence, I think is also extremely important for a founder to even understand their businesses better.
That's bingo right there, right? Which is, I think there's two levels of conversation. One is the founders understanding the business, but also the consequences of understanding or misunderstanding the business. I'll talk about the misunderstanding the business pretty quick, right? Because, the truth is the VC is putting money in, but the worst case scenario is that the VC already knows that they're going to lose 3/4 of their investments on the companies.
Yeah.
So it's already kind of like written off in advance. But to the founder who loses that company, they lose everything, right? They lose the team they've built, the problem they're going after, the sense of mission, the years of their life going after it. And so in many ways, I think the cost of inadequately financially modeling and understanding the downside in both capital requirements and capital inflows is way more painful. And so it's this interesting dynamic where it feels like the VCs are the one asking for financial modeling. Right. When I always tell people, I was like, the founder should be the one who is most invested in the financial modeling because the consequences are so asymmetric, right?
Absolutely, and that's what's really interesting actually in this and also our experience at Finprojections. So we are doing financial advisory for startups, and we're helping startups with financial models. And the number one, I think, trigger point for wanting a financial model for a founder is basically pressure by an investor, right? They are about to have a conversation with an investor and they're overdue in sending in a financial model, and that's the point at which they're scrambling to get one. But again, to your point, Jeremy, I think it is necessary. It just from a perspective of enforcing financial discipline early in the journey as opposed to later in the journey, and it can avoid a lot of pain down the line. In fact, one of even working with founders and just going beyond Excel and financial modeling, I think from a sort of a day-to-day perspective, one of the most painful experiences that I've personally seen founders go through is laying off people. And it is such a disappointing and crushing experience. And so it's not just, basically getting some items off of your P&L statement. There is a real human consequence to this. And to the extent you can lessen that blow, I think the better. I think the better for the founder's experience as well in building that business.
I agree with what you said, which is that, I think what you're implicitly saying is layoffs happen when you overhire because you didn't financially model right. Is that one way of thinking about it?
I think, yes. I mean, overhiring, but also just thinking about the quality of revenue, just generally.
I see. Yeah.
So I think that is one aspect that oftentimes, becomes very topical later, later in the evolution of the business. But in my opinion, it should be actually important much earlier, even when a company is in a hyperscale. There is opportunity for you to still, I think, measure at a fairly high level, but still the opportunity to measure what is the quality of the revenue that you're bringing in. And if you're burning cash to earn revenue, why are you doing so from a long-term strategy perspective? I think those are some of the fundamental questions that can be asked a lot earlier, and it can avoid pain down the line.
I love what you're saying. So tell us more about what quality of revenue means for those who don't know what that means, because people are like, isn't revenue a revenue, right?
No, absolutely. So quality of revenue, I think there are a few ways to look at it, right? So one way, which I recommend to most startups is you should be thinking about your customer base in terms of cohorts, right? And you should be tracking revenue in terms of cohorts. And that's an organized way to think about revenue that comes in. Now, what are cohorts? Cohorts is basically, let's say, this is the month of August. So what are all the customers that I brought in August? What amount of revenue are they contributing today? And then for the next 12 months. So you are tracking basically all these customers that have come in August over time to see how the revenue that you're getting from this cohort of customers evolves over time. And if you're seeing a lot of drop off in the revenue contribution from this cohort, that basically means that you are experiencing high churn of revenue from your customers. In other words, you are doing a lot of paid marketing to acquire customers, but you're not being able to retain them, right? And then a number of reasons why that might happen. It might happen because you are basically being very generous with your discounts and promotions in order to capture market share. But in terms of the value proposition, the core value proposition of the product, you're not really delivering in the long term. So while people are attracted because things are cheap, they're not staying on because there's not continued value. And so when you actually look at revenue from a very organized cohort-based standpoint, you start to see some of these symptoms of the revenue quality being poor. In other words, the revenue that is coming in and contributing to the growth does not sustain, does not stay, it drops off. And that is one way to look at it. There are also other ways, but that is fundamentally, I think, big challenge that I see is a lot of money being paid on acquisition, but not enough attention being spent on retention of revenue.
Yeah, and I think that's so true, right? Because the operator view on that, from my perspective, is if you are doing what you're saying, which is most of the time, which is that you are improving and getting smarter month to month about how you bring on new customers and onboard them and retain them, then it should show up in the numbers. And if you are able to break this out by cohort, to the investor that you're actually better than your average number, right? which is
Absolutely.
your average number is going to be a mixture of your bad cohorts in the start and
Yeah.
your average cohorts in the middle, and then your better cohorts in the recent past, right?
Yeah.
And so it shows the trajectory where you can be like, and I believe that I was able to improve this by 10% over the past 6 months. I
Right.
can achieve another 10% improvement in the next 6 months, and this is what the future looks like, in the next 6 months to 1 year.
Exactly.
And so I think it gives a lot more weight because it allows you to not only, so as you have average, now you have the past, but you're now able to show the trajectory and then forecast the
Absolutely.
future, right? Yeah.
Absolutely, absolutely, and I think when you're telling the story at a high level, you're often quoting metrics or projected metrics like LTV over CSC, which is just another expression of expressing return of investment on acquisition, right? So you're projecting that these numbers will go up, but why would I as an investor believe that these numbers would go up? What is the evidence of that? And so if you have done that exercise of tracking cohorts, and if you're showing month-to-month improvement, then there is reasonable basis to believe that yes, that trajectory will continue and we will see those numbers to be achieved.
Yeah.
So absolutely, Jeremy.
And one interesting thing that as a result happens is that, people are like, okay, why should I have these projections or not? But they also end up in a situation where they're like moving stuff around above the line and below the line. So, it's very much a conversation. It's like, okay, let's not look at revenue. Let's look at GMV, right? The gross value, right?
Yeah.
And then, let's look at revenue. Okay, gross revenue, but we, I think I saw a model recently, and then, just look, let's just say it relies on a lot of drivers and riders, right? And so they move driver incentives and driver retention bonuses, as well as rider incentives and rider retention bonuses below gross revenue, right? Into which had a intended impact of having and creating a more positive gross margin, for example. Of course, still shows up in the net loss overall. So could you share a little bit more about why you think someone would do something like this, or why?
Yeah, I mean, I think the operative thinking generally is that you want to run a loss on a unit economics basis because you want to capture eyeballs and you want to capture the market, right? So it's often this land grab kind of strategy, which I mean which is justifiable, but then also you need to be aware as a founder of what you're signing up for, which is basically constant fundraising and being able to meet the expectations of growth. Um, so that's really the operative reason is that you're, which is systemically important in a particular market, and to be systemically important in that market, you need to be able to capture a certain amount of market share, and you are sort of pursuing this loss leading strategy in order to capture those eyeballs and take away market share from incumbents. Um, uh, but uh, but also, I mean, while that is true, I think there is still room to question whether you are taking away market share by just running more attractive economics by burning cash, because that is not again a sustainable strategy. Because if all of a sudden you need to flip the switch and reverse the economics and take more of that GMV as your revenue. And all of a sudden, if your customers are leaving, they're churning because now you have flipped the switch on them, then it's not sustainable. Then you cannot actually hold that market leadership position in the long run. And then there'll be another new entrant who will run the same strategy that you've run on the incumbents and take your market share away from you. And you see a lot of that. I mean, this is highly theoretical, but you see this all the time, right? In a lot of these markets, in ride sharing, we've seen this also as an example. And so there, I think you need to really think about, okay, if you are burning cash to capture market share, how do you retain that market share in the long term? what is your long-term strategy of becoming something beyond just that strategy in order to create value for your customers?
I realized we got pretty advanced real quick, right? Because
Yeah.
we started describing three different things, which was firstly, how do founders maneuver their books, right? And then two is really like the growth strategy of what negative blitzscaling looks like. And then thirdly is really what the like dynamics and trade-offs really are associated with that. So I want to back up a little bit about that. So I want to paraphrase what we just discussed. What we said was, there's a lot of companies that obviously have a standard, cash flow, P&L, so forth, SaaS economics, pretty standard. And I think there's a moment where when founders are getting into the financial projections and they start maneuvering in a way to make their gross margin look better or your unit economics look better than they actually are, right? And then I think where the fork is that that's justifiable in one sense if you're choosing to blitzscale. Nowadays it's called negative blitzscaling, which is when you're blitzscaling at a loss. So historically, blitzscaling was meant to be, you're still supposed to be overall gross margin profitable. But now there's negative blitzscaling, which is even more aggressive version of that with cheap capital. And the problem, as you talked about, is that you need growth, a lot of growth to compensate for the fact that you don't have revenue. And then because of that, you need a lot of fundraising to match up for that. But I think let's roll back a little bit somewhere in the middle, right? Which is that, imagine they are working with the finance person, etc. And now they're making a decision, which is how do you represent reality, right? Like move things above the line, below the line. There's a bunch of decisions to be made. And what's interesting is that there's a big desire to create the most optimistic version of the model, right? Which is like, in terms of the data structure, in terms of the rows of how money goes through down the system, but also through the columns, right? Which is about how they look like in the future. And so there's this tension between what the founder is promising and articulating versus what is the actual reality of the business versus what the investor is thinking, right? And so how would you advise a founder to articulate or have that balanced approach to modeling that out?
Absolutely. No, that's a great question, Jeremy. I think, as an investor also, when I have looked at pitch decks, I think one of the most common charts that you see on a startup deck is this hockey stick growth, curve of growth or GMV or what have you. And you know what, like that's not, that in itself is not an issue because, as a VC, you want that type of hockey stick growth in a business, for you to justify that investment. So it is really emblematic of a VC-backed venture. But what is more the issue is that, as an investor, you have no way to really double click into those assumptions or into those projections and really understand this hockey stick growth that I'm seeing, what is it really coming from? What needs to happen in terms of, let's say, capturing a percentage of the market, in terms of retention, in terms of even, unpacking other business models for the business to reach those targets of revenue, and then also to reach other bottom line targets as well. And that's where I think, kind of very prudent financial modeling, where you're allowing the investor not just to see the high level numbers, but also to double click into the underlying assumptions is really valuable. Because then, as a founder, you're not just saying, okay, I'm going to quadruple my revenue over the next 3 years. You are also explaining from the very value drivers, from the bottom up basis, how exactly are you going to get to those numbers? And that's a lot more credible way of articulating that vision than just sort of, saying high level numbers to an investor.
Yeah, 100% agree. I think it's a forcing function to create a logic pathway of how the business works, right? And I think what's interesting is that, from my work, seeing so many founders, is that I think there's this pressure to really kind of like shuffle, the structure of that, right? Which is still the same numbers, but, in a new flow, right? Whatever you want to call it that. And I think, and it has a nice effect of like making the business look better, I think, full stop, like what we just talked about, moving driver incentives and retention as well as rider incentives and bonuses below the line, right? And I think what was interesting in that discussion, I remember, was my concern was that it was causing the internal team, the actual operator team, to also lose track about what to do and build, right? Which is, I think my concern was, and I think a founder was like, oh, it's okay, I have like two models, right? One for the investors and one for how
Exactly.
the business actually runs and what
Yeah.
I want to
Yeah.
do, right? Because
Yeah.
and I was like, whoa, like
Yeah.
that's not good, because I'm really worried that you're drinking the Kool-Aid because that's
Yeah.
what you committed to someone else. And so I think that was the tricky conversation that I was part of. I don't know what you think about that.
Yeah,
Yeah.
no, absolutely. I think to be honest, Jeremy, it's a recipe for disaster. Because if you're telling two different stories, or if you're articulating a strategy in a different way to investors as you are embracing it internally, then let's say that investor believes you and comes on board immediately. There is misalignment, right? And your life as a founder is so much more difficult now because there's friction at the board, and decision making is difficult, and the organization is not working in lockstep in perfect harmony. And that's what you really want as a founder is you just don't want capital, but you want capital that is on board with the plan that is actually being executed, not on a fictitious plan that they should find out after investing that is not true, but the real one which they that they might be a little bit uncomfortable with, but still signing on to, and that creates, I think, the right premise to work in harmony. And so there are massive risks of doing that in terms of misalignment.
Yeah. And I think the interesting part is that misalignment. And I remember having the conversation, I was like very much like, and I was thinking to myself, and I said this to one of the group, and I was very much like, the smarter VCs will understand this, right? Because you see like 2,000 decks, you
Yeah.
know, thousands, and you see all of them, and then
Mm.
you kind of get wise to the most common errors, the most common faulty assumptions, the most
Mm.
common like sleight of hand.
Mm.
And I always say, like, in the best case scenario, they catch it and they just don't invest in you. In the
Yeah.
worst case scenario, they go in and then they realize that is not kosher, and then you
Yeah.
break the trust, right?
Yeah.
Which is way worse, right? Because then you're stuck to each other, building a
Exactly.
business with two different stories, and without a working relationship at the board level. And I think that's a tricky conversation to
Yeah.
be having.
It's very difficult, and being a founder is difficult as it is. I mean, there's so many different challenges. The last entity you want pushback from is your board, right? I mean, you want ideally a board that is working in perfect harmonization, that is enabling you, empowering you, trying to add value, and really believes in you, and you're not one that does not trust you, right? I mean, that's just an awful working relationship, which worsens an already difficult experience of being a founder.
Yeah, and I think what's interesting is that there is an interesting divergence, um, because the truth is not all founders are great and not all boards are great. And I think the best case scenario is you have a great board and a great founder working in harmony, right?
Yeah.
And then on one hand, if you have a bad board and great founders, there's a lot of horror stories out there. And then on the other side, you have not as great founders, and boards that are not performing or performing well.
Yeah.
So I guess to some extent, there was like WeWork, Uber, um, Theranos, Revolution Pre-Crafted,
Right.
where there's a lot of debate about the fact that people wanted the more aggressive stance in acting earlier, um,
Right.
around financial controls and internal
Right.
controls and things like that, and governance, basically.
Yeah. No, I think Jeremy, generally, I again, I mean, and this is also why Finprojections, I think to a certain degree, I believe that something like Finprojections is so necessary, is because I think no VC in the world probably wants to be completely hands off and add no value, right? Because it is it is imperative for them to be able to show value creation, even to raise future funds, to show to their own investors that look, we are more than just the capital. And so they want to also exercise some of those governance muscles and build those capacities. But as a VC, if you're making 30, 40 odd investments out of a fund, I as an investor can attest, I work for a private equity fund and we don't have nearly as many investments as a VC, but it's a challenge to actually give adequate attention to all the portfolio companies. And imagine now multiplying that by a times of 4, really, really difficult to give adequate attention to all your portfolio companies in a very kind of operational way, right? So what I would imagine is most VCs are probably providing a lot of value at the board level, working on strategy, but not being able to really drill a level deeper and look at aspects of financial control. And that's really where you need external parties, third parties, who can provide these services to come in and supplement the efforts of VCs to do that value creation for them, and work obviously in part with the board, but also with the founders closely to create that discipline within that organization.
Yeah. And what's interesting is that as we talk about this, it makes me feel like, a lot of the worst issues, I think, with fraud, I think, especially in the startup land, my suspicion is actually they all didn't start with like an intentional goal to deceive. That's my
Yeah.
sense, right? As I talk to you, I think I'm starting to have this brain wave, I guess, that I think everybody just started and say like, this is the best way to structure the model that looks good.
Yeah.
And then it just keeps going, right? It's kind of like WeWork, right? And then, there's one way to look at
Yeah.
it, which was as a technology company.
Yeah.
And the other way to look at it is that it's a real estate company. And I remember
Absolutely, yeah.
even before everything went to shit, it was like, that was the talk of town, right? And I remember hanging out with investment bankers, and then
Right.
The tech bankers were like, yo, the real estate guy should do this. And the real estate people were like, no, the technology people should do it. Because
Right.
people would just kind of like touch and go about like the dissonance, right, between what kind of business it actually is, right? And
Right.
how it should be modeled out. And that was a big reset.
Yeah, no, absolutely. I mean, I think, Jeremy, I mean, most definitely, I think there is, there are a lot of these issues actually manifest, as the expectations build up, right, on the founder because of, very, very rich valuations that money have been raised at, right? So you have to keep up that pace of valuation trip, and therefore you need to show progress, and you need to justify why there should be that valuation trip upwards. Um, uh, but also, I mean, I would not completely also recuse the investors as well, right? Because, WeWork did take a massive amount of money from SoftBank, right? And if you would just like hand over $1 billion to a business, without questioning what exactly that they're going to spend it on, then if you're going to give someone $1 billion just like that, you also have to make sure that the valuation is at a level whereby the founders don't get too diluted, and thereby you've just jacked up the valuation massively, and therefore created this massive expectations on the business, right? So I think there's also some maybe some part for investors to play also in this dialogue, whereby they really sort of I think honestly ask the founder, okay, how much capital can you really take, given what you want to achieve.
So let's talk about that, right? Because every founder is having that decision, right? Which is, okay, let's do this financial model. Let's raise a certain amount of capital. These are the growth goals I'm promising the model for this amount of capital. Oh, I can get more capital, so I should increase my growth goals. Let's jack up the model. Or conversely, it could be like, VCs are saying that the growth isn't high enough for this amount of capital,
Yeah.
and I'm going to jack up the growth assumptions, but I'll keep the capital raise the same, right? So there's a little bit of that triangulation dynamic going on. How do you suggest founders think about should they triangulate? How should they be, tinkering or tweaking or moving those things around?
Yeah, I mean, I think it starts from a very fundamental, I think, analysis of what are the targets they can realistically achieve, and with what kind of support in terms of capital, right? And I think the founders are the best people to answer this question because they are the ones who are closest to the market, right? And to the extent possible, not compromising to what they feel is a high conviction sort of outcome over the next few years. And even when they're sort of offered, very rich awards of capital, I mean, they should still push back and say, listen, I just can't deliver that kind of growth, and so I need to take in less capital now and show you the results, and then probably take up more capital in the future. And that is a really difficult thing to do, right? For a founder, is to push back against capital. I think it's completely counterintuitive. But the reason why, a founder should explore that option is because as soon as you take on that capital, you should also realize that it builds expectations, to keep up a certain valuation trip, and that can completely, move the company into a different trajectory than what the founder was originally anticipating. And so, we really need to be honest as a founder, on what you can realistically deliver, and form fit the fundraising to that plan.
Yeah, I 100% agree with you that at the end of the day, the founder is closest to the business, and the founder is really also the master of the fundraising process. It's not an investor, it's not a team, it's not you and I, it's not a projection modeler. The founder is really the crux, right? And I think what you said about it is just like, this dynamic of, honesty with self, honesty with what you said is realistic to grow into, honesty about the capital needed. And I think there's this tricky dynamic, which is that I think there's almost two exercises, right? One is the first exercise that we talked about is really about the financial modeling exercise, where you try to figure out and you put out a presentation and you lay it all out. And I think that conclusion could be like, okay, we can make our model clearer, et cetera, and the numbers are going to look good or the numbers don't look good. And then, but I think there's an awkward step beyond that, which is if the numbers look good or numbers don't look good, it's a very separate question from does the business fundamentally good, or does the business fundamentally needs more improvement, right? And I think that's the really tricky part, right? Because I feel like sometimes people enter this financial projection dynamic and they need a capital in 3 to 6 months. And there's a huge amount of cognitive bias because the numbers don't look good, or it takes a lot of work to make them look good. But actually it's because the business is not fundamentally strong, right? And so it's hard to put that, lipstick on a pig, and that, that's the phrase used in America. But, like it's hard to do that, right? And then you don't have time to improve the business enough, So what do you think about that?
Absolutely, and it I think the problem compounds, right? I mean, you can get lucky as a founder. I think especially, and this is my personal feeling. I think especially now when there is probably like a deluge of capital in the private markets, you can actually get away with, just kind of, as you said, putting lipstick on a pig and being able to fundraise like a few rounds, right? But if fundamentally, let's say at the seed stage, if you don't have sensible unit economics, if you don't have quality revenue, and you're trying to just sort of build on top of that, and you're trying to accelerate that model, then you're taking something that doesn't quite work and you're just like kind of magnifying it like 10 times larger. So at some point in Series B, you have a much bigger problem. So what you should be doing is taking a step back at that seed stage and solving that sort of fundamental issue, and then accelerating the growth of that business. But oftentimes, I think you can get by the amount of capital that is being offered to you, and you want to take kind of that acceleration journey without fixing fundamental issues first. And that's why I think financial models are so important, because it can basically elucidate those fundamental truths about the business. Heeding those insights is a completely different exercise, and is a much more I think it's a very emotionally challenging exercise, right? Because as a founder, the startup is your baby, and to admit that there's something like really wrong with your baby and needs to be fixed is one of the most difficult things to admit, right? So but it's a journey that I think founders need to go through in order to make sure that whatever they're building is sustainable. And even if people are saying, yes, there's nothing wrong, we're going to give you capital, even then I think they should ask those hard questions to be able to build something sustainable in the long run.
Yeah, I agree with you. I think really do that financial modeling, not for the investors, but for yourself, right? Because it's going to help you fundraise better, of course, but also it will help you improve the business, right? And figure out what needs to improve. One tricky part about it is, why is it so hard for founders to, get a financial model if it's such a great vitamin and painkiller for so many different problems? Well, I mean, I'm sure you have a point of view in that, Sadaf, but why is it that founders find it difficult from your perspective?
I think the there are a lot of resources out there, Jeremy, right now on the financial models, right? So if you wanted to, figure it out yourself, you could. But the in terms of resources out there is twofold. Like one of which is being able to customize a model to form, like because every single business is different, and so finding a sufficiently sort of intelligent model that speaks to your business and being able to kind of morph that into your customized model, I think that remains a challenge. So to that end, what we're doing at Finprojections is we are building out a lot of specialized industry models, right? So we not only have a standardized financial model product, but we also have models by e-commerce, SaaS, logistics, fintech, even. And so, going a level deeper and articulating some of those business model subtleties into the model helps with respect to adoption and being able to, morph that into your model. And then secondly, I think, the other problem is a lot of founders are actually resorting to freelancing sort of websites to build a financial model for them. But oftentimes, on these freelancing sites, they're just sort of, trying to cost optimize and trying to get the cheapest model possible. What you really want is a financial advisor with experience who sits down and understands your strategy and aligns with you on strategy and builds that model on the basis of the strategy that has been agreed, not just sort of an off-the-shelf model that doesn't tell a story, but one that articulates your vision. And for that, I think you need, providers who will spend that time with you and who will also bring that requisite experience. I believe that Finprojections is differentiated because, we have sat on both sides of the table. We work with founders, but we also have the investor mindset as well. So, we try to bring a consulting engagement that really helps founders to a certain degree prepare for this investor conversation.
Yeah. I think the tricky part, of course, is that discovering that you need you or someone like you is pretty late in the process, right? Normally.
That's right. That's right. And it should be earlier. I really do believe it should be earlier, not so much for investors, but really for the founders themselves, as we discussed.
So how is it that you are thinking about approaching it? Because, I think one of the big issues of cost is also cost, right? The truth is, again, like it or not, the big driver for people trying to improve their financial models is to get it ready for the investors. And so they're looking for money. And because they're looking for money, they normally don't have, money, right? Unless, maybe if you're going for a Series B or Series C, I guess there's enough money at that point of time. By that point of time, you normally have a controller or some sort of fractional CFO by then as well. So how do you think about it?
Yeah, so Jeremy, so we want to basically create a product which is, form fitted for startups at every step of that journey. So as you had said, like, in the initial stage, at the seed stage, typically a startup is looking for a financial model just to be able to fundraise and to have investor conversations. And also at that point, probably the founders are not looking for something very complicated, maybe something that they can even build on their own. So for those stage of founders, the products that we offer are mostly DIY. So, people can go onto our website, they can download templates, but obviously organized by industry so that it's a little bit closer to what they're doing than just a generic standard model. And then alongside with all of these Excel templates, we also, plan to have a lot of video tutorials that describe exactly how these models work so that, the founders are not, downloading Excel and trying to work out how the Excel works, but really getting quality instruction as to how to operate it. So initially we have a DIY model, and then it gradually escalates into more customized builds. So if a founder feels that we should just build a model for them through a consultative approach, we can also do so. And then at the very sort of, I think, at the very end of the spectrum is obviously fractional CFO, where we come on board and we not only build a financial model on a customized basis, but we also provide ongoing services in terms of managing the model, but also some strategic financial advice, that can help with your ongoing reporting.
When you think about all of that, why is it that founders? Yeah, I'm just answering for myself, I guess. I mean, founders are busy. Founders are normally experts at a business, and they're experts at building a product. and no one's expecting them to be an expert Excel,
Yeah.
which is a
Yeah.
very different skill
Yeah.
set,
Absolutely.
for sure. I guess the way I think about it is, what's the best way for them to work or engage someone to handle numbers?
Yeah. I think the best way for them to, typically, I think if you're an early stage company, right, the financial modeling is typically outsourced, I think, in most cases, right? It's because, if you don't have that skill set internally, you're probably going to lean on some kind of a consultant. But I think the challenge is really with respect to updating that model, right? And keeping it refreshed on the basis of not just the traction of the business, but also if the plans change. If you have a change in strategy or a pivot, how do you now create a different financial model? It helps, I think, for a business then to have continuity in that process, to engage the same company that it did the first cut of the financial model to also engage for the second cut, because they're now already familiar with the business and the strategy. And thereby, I think you need sort of formalized service providers as opposed to sort of individual freelancers to provide this, in the industry. And so, in terms of how it manifests in real life, I mean, it would probably be a retention model, right? A fractional CFO model, where a startup, much like it hires an accountant, also hires a financial advisor. Part of whose job is to create the financial model, but also, on an ongoing basis to maintain it. And then the other really valuable thing that this fractional CFO can do is that this person can take the financial model that they have built that shows the projections, and then they can actually compare it to the actual numbers that are being realized to do very powerful reporting on budget versus actuals. And that gives the founder immediate feedback or a month-on-month feedback on where they're overperforming, where they're underperforming, right? So that is where you start to build that process and that engine of financial discipline and financial insights.
So, elephant in the room is, how do I know who's good and who's shit, right?
Sorry.
Because every founder meets a whole bunch of different service providers, right?
Right.
So how would I tell someone who's legit, you know, um, loaded questions, since
Yeah.
I know you're providing these services, but how would you test and verify? Yeah.
Yeah. So, I mean, I would, it's simple. I would say, Jeremy, it's basically, what are the questions they're asking, right? Judge the quality of the questions that they're asking. Are they listening to what they're saying? Are they asking really interesting follow-up questions? Are they asking questions that, are thought-provoking for you? I think that's where you realize that you have a provider who is, willing to pay attention to the details and really, craft a narrative that you would be aligned with and you would be comfortable delivering to an investor. So, judge a provider by the questions that they ask.
Yeah, I definitely agree about that, because I think it's a good dynamic for judgment, right? And you need that judgment to be exhibited for the model. And so having someone who really understands the business is a prerequisite to having a great model that is comprehensible. I think I'll probably add two things to it, of course, I'll say. I think the second,
Yeah.
of course, would be velocity, right? I think I've met quite a few service providers who have judgment, but are slow.
Yeah, absolutely.
And unfortunately, I mean, it's because maybe they have a lot of work, or they're overloaded, or
Yeah.
they're more chill and have a nice house after working with a bunch of startups on
Right.
their models and
Right.
things like that. I think velocity is really key, right? Because I think time is money, and
Absolutely.
I think the speed of iteration, the
Yeah.
turns, how fast they get back to you via email or whatever the preferred form of communication is
Absolutely.
really quite key. Especially because I think, especially in the early stages of the engagement, when you're like younger, seed or Series A, you're engaging someone like this. Time. This is a very critical phase of the company, and time is really
Yeah.
painful. I think Series B, Series C, things go a little. Time is a little bit more
Yeah.
plentiful, I would say, by that point of time, because the company is less of a house on fire. It's just a
Yeah.
maybe backyard on fire kind of dynamic. And I'll say the third thing that jumps out at me is also I think future orientation. Like commercial sense, maybe, like, which is like, this is the model that will be the best fit for the investors in terms of how they should understand the business.
Yeah.
And this will also be the best fit for your executive committee,
Exactly.
your leadership team to work with, right? That's
Yeah.
clear. And I think that commercial judgment is difficult because sometimes I think I've seen people build models that are high judgment, high velocity, but low commercial sense. And what I mean by that is the models are almost maybe too heavy, is accurate,
Yeah.
but not intuitive, descriptive, but not dynamic, right? And
Right.
they paint a picture as the business as it is and how it could be, but not really what needs to be done, I think.
Right. Right.
And I think
Right.
that's an interesting dynamic. I don't know, what do
No,
you think about
absolutely.
that? Yeah.
Absolutely. No, I completely 100% agree actually with both points. In particular on the last point, which is super interesting, is the model that you create for the investors. How do you also use it for internal discussions? Uh, it's sometimes really difficult because investors, especially institutional investors, want a lot of detail, right? So they want to be able to double click and they want to see how you're investing across channels and what have you. So they want to see a lot of detail. um, and but from a practical perspective, to use that model, this heavy model, for sort of for having discussions with management is difficult, right? So I think that's maybe the one setting in which I would probably think that having two models is useful. So having a sophisticated model for investors, but having effectively a much simpler version, which tells broadly the same story. So the numbers are not all that different, but having a simpler model for having internal conversations where you are a lot more focused on tracking a few metrics. Um, and you can then actually really, I think, use the same version of the model for not only having investor conversations, but also guiding strategy. And that's when the model can become really powerful, having become an all-encompassing tool.
Yeah, I think that's a good point. I think I share a similar bias, which is I think a simpler model on average is better than a more complex model.
Mhm.
Because, if everybody doesn't understand it at the moment they open it up,
Exactly.
then
Yeah.
it's useless, right? I mean, if
Yeah.
you understand the model and then you're like, oh, it describes 80% of reality, then at least,
Right.
you can always add on more stuff, right? More
Right.
modules to the Excel, or
Right.
you talk around the
Yeah.
exceptions or
Yeah.
scenarios. But I think if you're like 90% reality or 95% reality, but 50%, only 50% of the room understands the model,
Exactly.
then
Exactly.
I've seen a lot of
Yeah.
those, by the way, and I'm
Yeah.
just like,
Yeah.
yeah,
I
it's a
think
tough spot.
one maybe one thing to that we focus on, I think at Finprojections a lot, I think to address that very problem is the workings of the model can be incredibly complicated, but the outputs don't have to be, right? So the outputs typically come in the form of the financial statements, right? Now, how can you take those outputs from those financial statements and make them even easier to understand? And sometimes visualizations or charts are a great way of telling that story, right? And being able to pick out kind of the right charts for each sector to tell the crux of the story without, forcing the investor to go through the details, I think can be a great way of communicating a very complex model in a very simple way.
Yeah. And I think to add to that would be making sure that the inputs that the investor and the leadership team is going to want to change should be changeable.
Absolutely, yeah,
That's
absolutely,
probably the big one. Because,
absolutely,
there's a lot of inputs we can't change, right? We can't change the
yeah,
Singapore or Vietnamese tax rate for corporates or
right,
individuals or, you
right.
know, um, but there's a lot to be done about how growth rates, the actual acquisition costs, things like that actually do change.
Absolutely. And that's where I think the model organization also makes sense, right? So that's another issue that we also see, I think, when advising startups, is that the model that they have is I mean it's well built, but it's just all over the place. It's really difficult to find where the assumptions are, right? And the assumptions are hidden in like the 17th tab, right? And but the assumptions should be up front and center, right? That should be the first thing that should pop up when you open up a model, and you should be able to very intuitively operate that model and change things. And I think that organization helps not only in updating the model on an ongoing basis, but also for investor audits.
Yeah, 100%. It reminds me of the fact that, having been both a founder and now a VC, one interesting thing is a lot of founders asking me and say, hey, do you, after presenting to me for 20 minutes, it's like, do you think I'm running a good business? And I'm like, I don't know, because I mean, what I say is like, the truth is, I'm right now, I can only evaluate two things, right? Which is,
Yeah.
what is the actual business multiplied by how well you communicate the reality of this
Right.
business, right?
Mhm.
And if I'm struggling with how well you communicate the reality of this business, there's a lot of feedback I can give you about that. But that doesn't necessarily mean that I'm actually talking about the reality of your business, right? And if you have a great deck that explains it well, then I can quite quickly talk about the business. But if I'm
Yeah.
struggling with how it's being articulated in terms of numbers, in terms of model, in terms of deck, in terms of story, then
Yeah.
I struggle to have that point of view on the business itself, because I never even got there,
Absolutely.
right? I kind of got lost along the way.
Absolutely, absolutely, and that's why even before, I mean, Jeremy, to my sort of previous point, even before you build a model, it's really important to, uh, craft that story very clearly, right? So I'll give you one example, right? So when we work with a lot of founders, I think one of the issues that keeps coming up over and over again is that they have a B2B and a B2C, right? And they're driving it at the same time. And as an operator, I mean, even they acknowledge that it's impossible to drive essentially two different businesses at the same time. I mean, and if B2C is really what you're going to do, then why not focus on this B2C proposition? What is the B2B doing there even in the first place? Right. So these are some of the fundamental questions I think the founders need to ask themselves, because those are the same questions that will be asked of them by the investor. And then the conversation that they're having with the investor is a much more defensive one, right? Whereby they're trying to, effectively just defend the fundamental strategy, as opposed to really having a much more elevated conversation about the plans that they want to execute, which is closer to success than obviously this kind of lower level conversation on fundamental strategies they're having.
Yeah. And I think interesting, right, which is the tone, right? And I think that's a big struggle, right? Because I think, at the end of the day, the VCs the job is that out of 200 investments, they make one, right? And so they got to pick, right? So there's, like or not,
Yeah.
there's a judgment dynamic that's there. But in parallel, of course, different VCs have different choices about how friendly or human or helpful they are as well.
Yeah.
There's a different dynamic, right? But I think that judgment dynamic can be quite triggering, right? Because nobody wants to be judged, right? I mean, I was a founder and I met
Yeah.
those 200 VCs.
Yeah.
I didn't like getting judged as well. And I think now that I'm like more mature, I feel a little bit more understanding, or maybe because I'm on the other side now. So it's cognitive dissonance slash, begging for internal forgiveness or something. But it feels like a little bit more understandable now, right? Which was like, what's the right attitude, I guess, to go for it. I don't know if I had it, because I think I was more adversarial in that sense, because I was trying to convince someone
Mhm.
about how I saw the world, right? And how
Mhm.
this is a great business. And I think it wasn't great, because it's not,
Yeah.
every VC is thinking about whether they want to work with you, just as how much you want to work with them.
Mhm.
But I
Exactly.
think in parallel, so I think it lowered my ability to search for VCs who wanted to work with me on the business, right? Because
Mhm.
the conversation didn't go that way, right? The conversation went to,
Right.
I'm going to pitch you really hard and give you A, B, and C, but you lose the chance to like be with the person who can brainstorm with you. Um,
Right.
anyway, this
Right.
is just a thought about that. I don't know
No,
how
no,
you think about
absolutely.
it. Yeah.
Absolutely. I mean, I think yes, tone is really important. I don't think y- you know from an investor standpoint, from my standpoint as an investor, also, I don't think it's you know it's great to see, I think, founders with conviction, right? Because if they don't believe in what they're doing, who else would, right? They need to believe fundamentally that despite all of the possible risks, they're the ones who will execute this into reality. I mean, they will will it into reality. You need to see that in a founder, as as an investor, and that's great to see. But I think where it becomes a little bit challenging is when you are, I think when you're trying to be devil's advocate and you're trying to ask, fairly reasonable questions and they're not being addressed. right? Or they're being ignored, because then it, as you said, it I think raises those red flags or those concerns as to whether or not this is a person who takes feedback well, or this is a person who manages the board well, right? And it also raises concerns about the working relationship post investment, right? So yeah, I mean, I think that it's perfectly fine to have conviction, but it's also important to try to maybe answer the questions to the best of the ability. And of course, if they're not convinced, they're not convinced. They're probably not the right investor for you at the end of the day. But maybe a little bit of a balanced approach where you take the questions and try to make a good faith attempt at answering them is useful.
Yeah. I think that's the key phrase, right? Which is, good faith, right? What's the good faith approach to having that discussion, to having
Right.
that open discussion, right? Because, at the end of the day, the founder is doing such a hard thing, right? Which is creating the
Yeah.
future, right? And bringing it into the present. And so, the truth is nobody knows what the answer is, and nobody knows whether it's going to work or not,
Yeah,
right?
absolutely. Yeah.
And
Yeah. No one knows.
it's hard because of that, right?
Yeah.
I mean, if you ask me,
Yeah. I
like,
mean,
Jeremy is like, what's the speed of gravity? I'd be like, okay, I can Google this for you, right?
right. Exactly.
But you
Yeah.
ask me is like, can this business grow 10x over the next 2 to 3 years? I'll be like, whoa, like, it's not a yes no answer. It's more like, what do we need to believe? What do we need to work on?
Exactly.
What's most
Yeah.
important to focus on, and what's less important to focus on? Um, and that creates a more open discussion, I think,
No,
rather than right,
absolutely.
wrong,
Absolutely.
right?
No, absolutely. Absolutely. I think that's also something that is really interesting for the founders to, I think, also be able to assess about the investors that they're talking to is to what degree are they willing to brainstorm ideas with them, and entertain possibilities, right? Because if the investor has a very specific view of what a startup should be, let's say even pre-COVID-19, investors had a very specific view of businesses, and post COVID-19, they didn't have a changeable mindset to take a different approach to the business. They're pretty much screwed right now in terms of the investments, like, in a lot of industries, right? So you also need investors to be flexible enough to adopt to the market and to have those conversations with you when they get on board. And like, just the number of pivots that have happened, I think, in the recent past is a testament to that. And I think, there are boards that have enabled that have empowered that process, and there are boards probably that have been a blocker to that process. And really, I think it's important for the founder to suss out what is the dynamic going to be.
Yeah, I think that's really important because at the end of the day, this is how VCs are hiring founders by putting capital. The truth is, founders are also hiring VCs, right? Because you're
Yeah,
hiring the board that you're going to be working with for the next,
exactly.
you know, if you fail 2 years in the most painful circumstances, or if you are successful for 7 to 10 years, and you still go through some tough times as well. So in both cases and scenarios, you should pick someone who you really like and that you want to work with.
Yeah.
So wrapping things up here, Sadaf, always want to ask this question is, could you tell us about a time that you have been brave?
Jeremy, that's I love that question, Jeremy. And I actually didn't get we spoke so much about financial models, which I love, but didn't get to share too much of my personal story. But as I said, I've grown up in Bangladesh, and but I've spent much of my actually career outside of Bangladesh. I've spent actually the formative years of my career in the United States. But about 5 years ago, I decided to take a break from investing and decided to make a move back to Bangladesh and to work professionally there. And it was a really sort of, I think, interesting transition in my career, and it was really, I think, sort of spurred by this kind of, I think, this need to really experience what it feels like to be an operator as opposed to be an investor. So I moved back to Bangladesh, and I was working with a social enterprise which was doing education and launching education initiatives in the country. And I think I've learned a lot more from that experience of what it is to invest, and then as an investor myself. And that's something that I am so glad that I was brave to do, and that I think all investors should try to experience at some point in their lives, is to also sit in the operator's seat, because it creates a tremendous amount of empathy for what a founder goes through and the challenges that they face day by day, despite, like, overwhelming odds. They push on, and it's really important to experience that so that you are able to empathize with that as an investor. And so now as an investor that I've come back to, investing into companies, I find myself so much more empathetic and so much more understanding of the founders' needs and how they want to be guided, how they want to be mentored. And so that's something I'm really glad I was brave to do.
Amazing. And when you think about that, why is it important for you that this is your moment of bravery here?
It was important for me because up to that point, I had a very sort of one track kind of mindset with respect to my career. I think a lot of bankers do, which is, I'm going to do 2 years of investment banking and then I'm going to go into the buy side, and that's where I'm going to be for the rest of my life until I make partner. So it was a very like huge cognitive dissonance for me, of like leaving that track and going into a social enterprise in Bangladesh. But that was the right moment for me to do it, because I realized that if I didn't do it, then I would have I would get locked into a certain trajectory, which was a very traditional way of thinking. But I wanted to experience something different, and I wanted to explore a broader world that was out there and a broader set of possibilities than one that, which everyone was like kind of, I think pursuing. And sometimes I think in your career you have to take some of those risks because they feel right, and you feel connected to that, rather than sort of just pursuing what everyone else is saying is the right thing to do. And so that was why it was really a moment of bravery, because in spite of the well-trodden path, I decided to do something different, and it was richly rewarding also. And oftentimes you find these rewards by taking risk, and it requires bravery to do so.
Awesome. Thank you so much, Sadaf, for sharing. I'd love to wrap things up by paraphrasing the three big themes I heard from you. The first is thank you so much for talking a lot about obviously your subject domain expertise around financial models, right? Which is how founders should be thinking about financial modeling, thinking about how they should be thinking about financial trade-offs, and the dynamics that are happening, the incentives and the pressures, right, to articulate one story versus another story, and how to maneuver in all those situations. I think that was really sound advice. The second thing I really actually enjoyed was actually a lot of what I call the deeper conversation and subtext around the motivations between the founders, the leadership team, the VCs, and how they operate and how they behave, and how to present reality and how to articulate the future, right? And I think that was a great conversation, not just in content, but also in terms of frank tone, right? And thirdly, I really appreciate you sharing a little bit about your personal story, right? Which is about what Bangladesh means to you for home, but also as a place that you love. And really kind of like find it incredible that you're out, founding and building your own set of help for other founders as well in Southeast Asia.
No, Jeremy, that was a wonderful summary. It was a real pleasure to speak to you, Jeremy. And then, of course, really excited to roll out a lot of interesting, I think, services and products for founders in the ecosystem. And, hope it will be value add for everyone.
Awesome. And if you want to find you, where should they go?
Yeah, you can just look me up on LinkedIn under the name of Sadaf Sultan, or you can just contact me through finprojections.com.
Thank you.
Thank you so much.